I have quite a few headlines to go over in just the Web3 digital asset cryptocurrency space in general, and then some interesting tax headlines just related to some related to AI, some related to crypto, some related to crypto accounting, and then some interesting topics related to the IRS and some of their enforcement efforts related to cryptocurrency. There's a couple headlines related to that, and then a couple things I want to hit on just based off of some conversations I was having this past week. So let's get right into it. I usually like to start with the headlines first. So I'm going to try to share my screen here with you guys. Give me 1 second. Hopefully this works. Okay. So let me just make sure this is working. It appears that it is. There we are. Awesome. So first headline of the day, I'm sure you guys have heard all about this, but of course we need to touch on this. BlackRock applies for spot Bitcoin ETF, a US first if approved. I think BlackRock has only had one ETF application not be approved. So in terms of their track record, I think it's very likely and a very good sign that this one will get approved. This is a big step in terms of getting institutional adoption when it comes to Bitcoin and cryptocurrency in general. You'll see here on CoinMarketCap, based off of this news, we saw a huge jump in the market for Bitcoin with other assets following as well. So this investment firm joins a long line of applicants. ARK is among those still waiting to hear from the SEC. Grayscale has appealed their rejection. So, this one for BlackRock looks to be optimistic. It's done great things in terms of people's perception in the market here in the short term. In terms of, people's opinions on this, I see a lot of people excited for this, saying it's going to bring a lot of institutional adoption. And then, there are some negative proponents as well that are basically, saying that these types of ETFs can sort of be used to control the industry to a degree and, take it from more of a grassroots industry into the hands of some of these institutional players more. That's all yet to be seen. What is for sure though is that if this ETF gets approved, it's definitely moving us forward in terms of having a level of institutional adoption around Bitcoin and around other digital assets. So overall, I see this as pretty positive news. Another point on this that I want to try to see if I can call up my LinkedIn real quick here. Let me see. So one thing I want to hit on is a post I made yesterday on here, which sort of ties into this. We're just seeing a lot of sort of good news come out this past week. You'll see my caption here: no one can deny this forever. Federal Reserve Chairman says crypto appears to have staying power as an asset class. So this was Jerome Powell yesterday, I think, in a Congress hearing, where basically that was his quote: crypto appears to have staying power as an asset class. So, these are great headlines that we're seeing this week. Jerome Powell, head of the Federal Reserve, chairman of the Federal Reserve, even has to admit that crypto has staying power as an asset class in the same week that BlackRock is applying for a Bitcoin spot exchange traded fund. So, I thought these were positive headlines that we saw this week. Another interesting headline that came out on Bloomberg this week wasn't directly related to cryptocurrency and blockchain. It was more just speaking on tax topics and artificial intelligence topics. This is a topic I covered in the past, maybe about 6 months ago. It's coming up in the headlines again. I think this is going to be somewhat of a consistent theme or trend that we see in terms of, tax topics. as we start to see more AI and more automation. And you can see the headline here: AI fueled job displacement, anxiety triggers tax code scrutiny. So there's a lot of economists that are looking into the future in terms of how AI can automate a lot of people out of the workforce. And, taxes is one of the tools of an economist. And they are basically suggesting to use taxes as a tool to help mitigate some of the negative impacts from companies wanting to fire their employees to automate them through AI, basically by taxing the robots that would replace the employees, therefore making it somewhat more prohibitive and costly for companies to move people out of the workplace by replacing them with robots. So, there's two sides to this argument. Some people think that this is a way to sort of protect jobs and, slow this replacement of people with AI. Other people believe that, this type of tax is just going to be prohibitive on companies adopting AI to reach higher levels of efficiency. So comment below what your thoughts are on this. Should we tax the robots or should we not tax the robots? That's basically the question here in this article. So Senator Majority Leader Chuck Schumer has scheduled a series of briefings on AI as lawmakers attempt to understand the technology's developments, capabilities, and way to use it. Economists say the tax code can serve as a guardrail against bad effects on the workforce. A Goldman Sachs report shows that AI could dispose as many of 2/3 of the U.S. occupation to some degree of automation. So basically, they want to impose a tax on that to make it more prohibitive. So comment below what your thoughts are on this. Should we be taxing the robots, or do you believe that that'll stifle innovation, and that this is a bad approach to this problem that we're all facing in terms of automation and AI? So what I wanted to hit on next was a recent post that I saw on Reddit. Sorry, I don't think my screen was sharing. I just realized that. So I'm going to share my screen on this one. Okay, so now the screen's sharing. So I want to hit on this post on Reddit. Basically, this person posted to Reddit, this was 4 days ago, and he says, does filing correctly, he put it correctly in quotations, which does filing correctly for 2023 next April cause issues for past years? This is actually a pretty common question that I get because, this guy's fact pattern isn't really that rare. Let's briefly read through it. Like many, I have never realized that every DEX transaction is a taxable event. For years, I barely made anything. I was simply doing coin-to-coin trades, but the Ethereum appreciated. So technically, he'll probably have some capital gains if that's the case. Definitely less than $400 to $500 total. Some people end up being surprised when they go through all their crypto transactions when they're trading alts in a bull market, how much gains they can actually have. So he's not going to totally know that until he calculates it, but he's anticipating a low amount. Definitely a low amount, less than $400 to $500 total. This is the first year where realized gains are going to be in larger amounts that he perceives as material. So he's going to need to use the software to calculate this and start reporting it. So basically his question is, doing the absolute correct and perfect reporting this year will cause all types of errors for the 6 years of microtransactions in the past. Basically, he's worried, if I go and I claim my taxes correctly this year, am I going to cause red flags or cause a bunch of issues for all of the past years where he may or may not have been claiming it correctly, or it seems like maybe he wasn't claiming all of the trades in the past years. Now, this is a question that I can get pretty frequently. And the first thing that I basically suggest is separating your considerations between crypto accounting and your tax filings. They're two separate processes. So, my suggestion to this person would be, first, let's do your cryptocurrency accurate. And in order to do it accurate, if you weren't tracking it correctly in prior years, due to the cumulative nature of tracking your cost basis through multiple tax years, we would want to start with your earliest transactions and then do the accounting correctly for each tax year going forward into the current year. What this would do is it would give us an accurate accounting of all of your transactions with an accurate cost basis data that carries into the current year. Then what we would have is we would have the accounting for each specific tax year. The tax year that you want to claim, let's say that's the 2023 tax year that you want to claim, we would have that. And then we would also have all the prior year accounting, which from an accounting perspective was necessary for us to do simply to make sure we're tracking your cost basis appropriately and to even make a decision on your tax returns. So with that accounting, now we can look at the tax question of, okay, let's look at your prior year tax returns and let's compare what you claimed on your prior year tax returns to what our actual accurate accounting is. If there aren't discrepancies, or if the discrepancies are immaterial, like he was saying here, if it's, if you paid $100,000 in taxes last year, but your discrepancy on your return compared to your new accounting versus what you reported in the past is $100, that's immaterial. We probably don't have to go back and amend that. But if we get into a scenario where you've significantly under or over reported your taxes based off of your updated accounting, that's when we need to start considering tax amendments to make sure that we're in compliance when it comes to back taxes. So really what I would suggest that this person do is first just do their crypto accounting to get a clear picture of what's actually going to be accurate, what are your actual tax liabilities, and then let's compare that to your tax returns and let's determine what do we need to do to get into compliance. Are tax amendments necessary? Are the discrepancies immaterial and we don't need to really pursue amendments? In that case, he may be able to get out of amending, but it's all really going to depend on that specific fact pattern. So, I don't have necessarily enough information here to give more of an answer past that, but that's the approach I would take: is first do the accounting, then assess the accounting in comparison to the prior file tax returns. Now, just building off this point a little bit, with that cumulative nature of cost basis tracking, I think that's important to understand because two things. If you think that, you could maybe not have been in compliance for crypto taxes for the past years, however, if that's 1 year, 5 years, whatever it may be, and then go and file your current year, you are to a certain degree opening up a can of worms, because even from an accounting perspective, if you didn't do your accounting for all those other years, it's highly unlikely that that current year is going to be accurate due to that cumulative nature of your cost basis tracking. Now, I do think that this also needs to be considered from an audit perspective, because even if a taxpayer in the future is to get audited for a specific tax year, once your crypto accounting starts to get scrutinized, this cumulative nature to your cost basis tracking is going to come into play. So your 2023 may come under scrutiny, but when the due diligence is done on your crypto accounting for that year, it can start to work back into previous years when we need to start verifying cost basis information and things like that. So you want to make sure that you're in compliance for all tax years that you have crypto activity. And, that's the best way to protect your bottom line. So I thought this was an interesting question because, like I said, it's one that I see pretty frequently when, via my practice at CryptoCPA. So let's see. So next, I thought this was pretty interesting. We have the IRS is seeking contractors to improve cryptocurrency compliance. So let me share my screen on this too. You know what I think it is? I think I need to share my window. Didn't want to share this. So there we go. Okay. So IRS seeks contractors to improve crypto compliance. So this is a civilian solicitation. The IRS is seeking digital asset compliance solutions from vendors, including pricing analysis and custody management solutions. So the IRS is basically putting out a request for a government contract request for either professionals and or software companies that can help facilitate them with digital asset tax compliance and basically analyzing different types of transactions and applying a tax treatment to it. So here's a list of some of the tools that the IRS is looking for: identify digital asset transactions and transaction patterns, bulk analysis, supply digital asset pricing data. Currently, the IRS relies on pricing from public sources such as CoinMarketCap and investing.com, handle large-scale bulk transactions, offer digital asset computation solutions, provide digital asset custody management solutions. So, these are a lot of services that we offer to our clients. The IRS is basically looking to get contractors in order to likely audit taxpayers. So here's a little bit in terms of companies that the IRS has currently partnered with. I've covered some of these partnerships in the past and some of the spending that they've done in the digital asset space. So several companies, including Deloitte, Accenture, Chain Analysis, and some others here, have ongoing contracts with the IRS for digital asset tracking and analysis. So in 22, the spending reached nearly $20 million in government spending on cryptocurrency tax solutions. And you'll see a chart here. In total, 40.8 million contracts, just under a million in subcontracts, 41.8 in total. And you can see the growth. 2016, this is when I started doing crypto accounting. You can see there was not much of a focus on it back then. Started growing a little bit more. This sort of coincides with the market cycles here too, which is interesting. And now you just see steady growth. 2023 hasn't been that heavy yet, but we'll see if that increases. So I thought this was interesting. The IRS already has some interesting partnerships with Chain Analysis, with some of the big four and others, and they're seeking more, likely because they're anticipating a higher need in terms of the overall volume and activity in this digital asset space. On that same topic, digital asset marketplace analysis. So this is a request for information. Again, this is coming from the IRS, where basically they're requesting more information that goes into the cryptocurrency calculations. I want to scroll down to the questions. I thought these questions were pretty interesting. So some of them they're just asking, standard stuff like what's your name and company and stuff. Here's where they get interesting. Provide a summary of the background of any existing innovative solutions you've deployed since digital assets involved. What's your process for identifying and integrating new practices, recommendations for primary areas of focus? And these questions go on. How would you recommend the government leverage blockchain tracing? How would you recommend the government leverage asset custody aspects? How do you recommend the government leverage basis computation solutions? Because those basis computation solutions are going to be very important when it comes to audits. How do you analyze bulk data? The questions go on. So, this is showing a renewed focus from the IRS in regards to getting a better understanding and a better methodology of how they're going to handle digital assets. And this is because they see the growth and maturity in this space, and there's going to be a greater need to get people in compliance in this space, especially since, unfortunately, our industry still has somewhat of a reputation of non-compliance, at least to a certain degree. So, I thought those were very interesting. Now, while we're on this point, one comment that I get a lot, and it's basically, what does the IRS know about cryptocurrency? They can't track our trades. They don't know my wallet address. Is the blockchain's anonymous? Good luck to the IRS. These dinosaurs are never going to be able to trace my transactions on the blockchain. I cringe when I hear that because it's just so far from the truth. I've been basically hearing people tell me that the IRS can't tax their trades due to all those reasons for years now, for over half a decade. I've been hearing that since 2016. It's just not the case. And as the industry matures more, more and more people, unfortunately, are going to find that out the hard way. First of all, the blockchain's not anonymous, it's pseudonymous. And, that's not just dialectic, that's a large difference, because all it takes for a taxing agency to do is to connect your identity to a wallet address, and then they have all of your transactions. So for all the people out there that don't believe that they have to pay taxes on their digital asset transactions because the IRS doesn't have capabilities to determine if they're underreporting, I listed out some of the tools and resources that the IRS is currently using to do just that. So, and there's several of these. So I made a list because I probably couldn't even remember them all off the top of my head. So the first is AI and data analysis, using AI, using advanced algorithms to take large data sets and analyze them from a tax perspective, identify patterns in them along with any discrepancies or anomalies within that data set. That's one tool at their disposal. Again, like you just saw in one of those requests for proposals, they're partnered with companies like Chain Analysis, who's a blockchain company that works with various law enforcement agencies to help trace and track transactions across the blockchain. So, where they're going to be able to help the IRS is if you're underreporting and maybe hiding some wallets, tracing that flow of fund to uncover those wallets. I can't tell you how many times I'll get clients, and one of the initial things that we'll do when we're working with them is collect all their public wallet addresses for their non-custodial wallets, so we could run APIs to pull down their transaction flows. Then when we're tracking and tracing all of their transactions, it's a very common occurrence where I'll find wallets that they own that they didn't tell me that they own. Usually it's not for some nefarious type of reason. They just forget that they own the wallet. But through this process of just tracing transactions through the blockchain, you can really follow the flow of funds. And if someone's not telling you about a wallet they own, it takes time and effort, but through chasing the blockchain and through using tools like chain analysis, you can uncover this information. Another big one is subpoena power. The IRS has subpoena power over individuals, exchanges, and other entities to obtain your cryptocurrency transactions. So the big one that we see here is, various exchanges with John Doe audits, um, just basically getting your data from one of these exchanges, and then if you didn't report that information, they calculate a tax owed on that. I see a lot of people will come to our firm after getting a tax notice from the IRS because they didn't claim their transactions, and an exchange reports on them, or the IRS obtains their information through a John Doe audit, and then the IRS will basically put out a tax notice saying, hey, you sold this much on this exchange. They have no cost basis data. Therefore, your tax is this. Usually those are going to be inaccurate because they have no cost basis data associated with them. But and then you're going to have to work through responding to that notice and correcting it. So, but they will be able to get that information. In addition to just subpoenaing exchanges, the IRS can access other forms of information from you. This could be your email addresses, your banking records, for example. areas like that where, like the reason your emails would be valuable is because if your email is connected with an exchange, you may get a confirmation, hey, congratulations, your purchase of this 20 Ethereum was successful, but you didn't report it on your taxes. Similarly, on the bank accounts, there can be outgoing or incoming funds that are coming from a centralized exchange that you're not reporting on. That's a great way to catch someone under reporting. So using this subpoena power and just collecting data and information is a tactic that's commonly used. Whistleblower programs. It's another big one. This is for all the people out on Twitter that want to brag about not paying taxes. The IRS has a whistleblower program that incentivizes individuals to report on potential tax evasion. So if you're not paying your taxes and somehow the IRS doesn't have any information between your exchanges, your emails, your bank records, all of that, and you somehow manage to cash out a large amount of crypto and you want to go buy a Lamborghini or you want to go buy a mansion or buy, something that's going to attract the attention of others, this can lead to you getting reported on via a whistleblower program. If you're making purchases that are outside of your means just from your basic job, or if you just got a big mouth and you're telling people that you're not paying taxes and you tell the wrong person or you piss off the wrong person, you can unfortunately become part of that whistleblower program. So these are just some of the tactics that the IRS has at their disposal. They also, while we're on this whistleblower topic, they also will monitor social media, especially if you're under an audit. So, all these people that want to talk about tax evasion on the internet or talk about sort of haphazard tax planning strategies on the internet, I think that's a terrible idea, because if you do come under scrutiny, all of that can come to light and can negatively impact you. So there's many ways that the IRS can come after people that are underreporting and that are not into compliance. And as the industry grows, the focus of regulators, including the IRS, are going to grow with it, as you can see by some of these requests for proposals and government contracts that the IRS is putting out. So it's very important that if you're not fully into compliance, you work with a tax professional and or a tax attorney and you get into compliance as soon as possible, because these aren't the types of issues that are just going to disappear. And when you factor in that cumulative nature to tracking your cost basis data, this is something that can just continue to follow you into future tax years in perpetuity. So, those were some of the big things that I wanted to hit on today. If you guys have any questions or any comments related to some of the topics that I covered here today, leave your comments below. I'm really interested to hear your thoughts and your questions. I'd like to start addressing some of your comments and questions further. So leave those below. And if you're looking to get regular updates like this, I'll be going live every Thursday. And every Tuesday, I have a newsletter called the Digital Asset Digest, where we deliver a lot of this information in newsletter format, where I'll cover some of the largest headlines that relate to Web3, digital assets, tax and accounting, as well as going over some of the issues and some of the new things that I'm seeing on a weekly basis in my practice at CryptoCPA. So I appreciate you guys taking the time here to watch today. Until next time, I'm Patrick Camuso, signing off.